And we'll be live on multiple platforms in just a second here. And awesome. I think we are live right now. Fingers crossed. Um, well, yeah, I believe we are live. Awesome, everybody. Thank you for joining us today, taking time out of your busy day to join us on this interesting session that we have planned on maximizing your wealth. Specifically, what we want to be looking at are the different tools that you can use for investing. And when I say tools, I'm talking about RRSPs, tax-free savings account, corporate investments, first-time home savings accounts, all these amazing tools that are at your fingertips to help you grow your net worth. And as you guys know, my name is Andrew Wall. I'm the managing partner here at CPA4IT. And our mission at CPA4IT is to help you organize your finances, create wealth, and transform wealth into a legacy. In today's session, we'll talk a little bit about who we are, talk a little bit about what tax planning is, briefly cover salaries versus dividends, as well as income splitting before diving into the meat of why you guys are here, which is where you should actually save your hard-earned money to give you the best bang for the buck. And we'll be going through some of the new accounts, like the first-time home savings account, which doesn't appear in this slide, but I promise you it is in the presentation and we will be covering it. So as I mentioned, our firm is named CPA4IT. We started back in 1984 when my father, George Wall, founded the firm. We've been specializing in service-based businesses since the onset, starting primarily with IT consultants, now serving realtors and doctors as well. We've been fortunate to win a number of awards, and we've got a whole bunch of value-added benefits, but I'm not going to belabor you with all those accolades. Instead, I may tell you just a little bit about why people do choose to work with us, which is basically we offer a turnkey solution, which means that we can help you from cradle to grave, from incorporating your business to doing the bookkeeping, to doing the accounting, to dissolutions, to minutes, to shares, to all these important things, as well as working with a team of advisors to work as your financial quarterback to help you organize your finances, create wealth, and transform wealth into a legacy. We also offer some proprietary products like our benchmarking analysis and our audit representation protection. And of course, as always, we offer free initial consultations for anyone who might be watching this live on social media and is interested in learning more. There's a free no obligation consultation. You can book it on our website at cpa4it.ca. And that's it. We're going to jump right into what is tax planning here. So this is, for those of you who aren't familiar with tax planning, it is fundamentally the analysis of your personal financial situation to develop a plan from a tax perspective. And the purpose of this plan is to ensure we can pay as little taxes as possible. And we also want to make sure that we're doing that while reducing liability and maximizing your ability to retire. So as I said, and I'll repeat it over and over again, our mission is to help you organize your finances, create wealth, and transform wealth into a legacy. And tax planning is a great aspect or tool to use to help you to create wealth because we can use strategies to help you minimize tax. So how do we do that? As accountants, the first thing we need to know and understand is the marginal tax rates. So here in Canada, we have a marginal tax system, which means as your income goes up, so too does the amount of taxes that you pay. Now, the good news is as you move into another tax threshold, you don't pay more tax on all your income, only on the income that's in this new threshold. And so a lot of people have asked online, I'm sure not you savvy listeners who are joining us live here in Zoom as well as online, but some people thought that if you get a pay raise, you could be bumped into another tax bracket and you'd be paying more taxes than what your raise is. That will never happen. With the marginal tax system, as I said, if you get bumped into a higher tax rate, all the income below that tax is still taxed at that lower tax rate. And so we've got the tax rates for 2024 broken out here. So we've got your first tax bracket, which is about $51,446. And I'm looking specifically here in Ontario. you're looking at a tax rate of about 20% on that. Now, there is also a basic exemption, and that is slightly different federally and provincially, but there's a certain amount of money that you can get completely tax-free. And so when we're looking at your tax planning, even if there was no obligation to pay you a salary from your corporation, odds are we'd want to at least bring you up to your basic exemption, if not up to the lowest tax bracket. But what we're trying to do when we're doing your tax planning is look at how much money you've taken out of your corporation, what kind of strategies do we have to account for the money that's come out of the corporation. Is it, first of all, hopefully it's a deductible business expense and then it doesn't have to become income at all. If it's not a deductible business account, can we leverage some of our top 10 tax strategies like home loans or auto loans or single purpose loans? Then we're going to look at your personal situation as far as do you have other income, as well as your whole family situation. And we'll go over tax splitting in a second. But the goal of which is to basically give you as little an income as we possibly can, because as you can see here, when you get over $246,000, you're paying on the personal side over 53% in personal taxes. And if we can leave that money inside the corporation only pays 12.2% here in Ontario. So that is a significant savings of over 40%. And the benefit of leaving that in the corporation, even though eventually you may need to take it out and pay tax on it, is if we can invest the money and have 88 cents left over after taxes to invest, that is certainly better than having 46 cents left over to invest, because when things grow and invest and compound, if we start with a larger number, it'll grow substantially faster. So that's our fundamental goal and objective in the tax planning, is to keep this as low as we possibly can. We do this with a number of different tools that we have, including dividends, which are a great retirement strategy. Usually during your income earning years, we're going to stick with salary because there are some new rules, tax on split income, that affect our ability to do dividends to family members now, but it is still a viable strategy in the right place. We also like to smooth income, and we'll explain that a little bit more as we talk about income splitting, because income splitting is really giving us a big advantage of being able to reduce the amount of taxes you pay by smoothing that over more people, and more people means more basic exemptions, more lower tax brackets, less tax overall. And then, of course, leveraging the small business deduction by keeping as much money in your corporation and using things like tax-free loans for home loans and car loans and single purpose loans to account for the money that has been physically withdrawn out of your corporation in ways that aren't taxable for you. And as accountants, we often have a trick or two up our sleeve. And of course, the best way to do that tax planning is to look at your personal situation, understand exactly what's going on, and come up with a strategy that's specific to you. So unfortunately, if any of you were coming to this episode hoping to get a specific tax strategy for yourself, unfortunately, that's not something we'll be able to do here today, but we'll be able to give you lots of general advice that will help you figure out an overall strategy for yourself to help you get the most out of the money that you're earning. So I do want to have a brief discussion on salary versus dividends, because this does affect our tax planning. There is a misconception out there that if you take a dividend instead of a salary, you will pay less taxes overall. Unfortunately, that is not true. What happens with a dividend is that you get a tax credit personally to account for the taxes that have been paid for the company that is issuing you the dividends. The reason they do that is because dividends come out of retained earnings, or money that has been taxed at the corporate tax rate, whereas salary comes out as a deductible business expense before taxes. And because it comes out before taxes, as an individual receiving salary, you've got to pay the full personal tax rate as opposed to getting that discount on the dividend. But when you add in the taxes that have been paid inside the corporation with the taxes that you will pay as a shareholder, those combined will equal the same amount of taxes that you would pay as an individual receiving a salary or a T4 income. Now, with a dividend, we also have some new problems with TFSA, or tax on split income, where if you have a family member that you're looking to do any income splitting with, there are requirements around their certain number of hours that they need to be involved in the business in order to qualify. And that is dependent on their age and a couple of other factors. Now, there are some exemptions. Once you hit 65, you can do income splitting with your spouse. not your children, but your spouse. And again, happy to talk to individuals on a one-on-one basis to figure out if that's the right strategy for you. But the issue with the dividend is it's not going to be eligible for CPP, and it's not going to be eligible for RRSPs, which are two financial strategies that we personally believe are worthwhile. Now, if you personally don't believe in contributing to CPP and giving yourself some guaranteed form of retirement income, and you don't believe in leveraging the value of RRSPs, which we'll be explaining in more detail today, then you can certainly elect to go with a dividend. And the benefits of the dividend is that it does give you better cash flow. And what I mean by that is with a salary, you have to remit payroll taxes. You have to take money out and give it to the government. And there's specific deadlines. If you want to know what those deadlines are, go back and watch our payroll source deduction webinar on our YouTube channel. But you have to pay the money in earlier than if you were to go with a dividend. Now, with a dividend, yes, the corporation is going to have to pay their taxes whenever their fiscal year end is, but the shareholder doesn't have to pay their taxes until they file their tax return in April. So you've also got a little bit more flexibility, particularly if you have people who are actively involved in the business, because outside of that, actively involved in the business, there's no criteria around how much that you can give them. Whereas with a salary is subject to a reasonableness test. And so if you are paying family members like children, it is subject to a reasonableness test. So you can't just pay your children $100,000 a year to clean up your office. But it is a way that we can still remain to do income splitting with the children if they're not working that full 20 hours a week that's required for dividends. Again, if you have any more questions, feel free to throw them in the Q&A, but I'm going to sort of bump over to income splitting. Because income splitting is another tool that we use to help you keep more of your hard-earned money inside your corporation. And really what benefit you're getting here is that ability to use more of those lower income tax brackets. So for example, if we look at a real world example of someone who's got $100,000 of income, and if they were to take that into their salary just as themselves, they'd be looking at combined taxes payable of about $30,000, just under $30,000, and netting out only about $70,000 of that to keep in their pocket. Now, with two individuals splitting that, or if that were split over 2 separate years, you're actually only paying about $25,000, just over $25,000 in combined taxes payable, including the CPP. And that leaves you with over $74,000 of that original $100,000, which is a savings of over $4,000 just in reduced taxes. But what you actually are also getting is a greater CPP contribution, because now you've got two people who don't quite have the maximum in this particular scenario, but you've got two people with over $5,400, almost over $5,500 and CPP contributions, including both the employee and the employer. Whereas the other situation, you have one individual who's maxed the CPP contribution, but for a total of only about $7,500, which is another couple $1,000 that effectively goes in your pocket. It doesn't go in your pocket today; it'll come into your pockets down the road once you start receiving the Canada Pension Plan. But with CPP, the key is the more that you contribute, the more that you're going to get in retirement. So as I said earlier, CPP isn't necessarily going to be the highest return investment that you will ever see. It is a guaranteed form of income in retirement. And after seeing so many issues with market ups and downs and collapses, we know all too well that it is important for our clients to have at least the base threshold of the CPP and OAS that they can leverage in retirement for your financial plan. So now let's assume that you have money left over, that you're earning, a couple $100,000 in your corporation, or even $150,000, but you're only taking out 100, and you got, $50 or even $30,000 left over at the end of the year. And you want to figure out, where should I invest this money? Should I put it inside my corporation and invest that in in the stock market and GICs and real estate and whatever you might choose to invest in, or should they put that into an RRSP or an RESP or a tax-free savings account, or all these different acronyms that are available, and how do you determine what's actually best for you? So that's the real goal of today's session. And we're going to start by first looking at the RESP, which, if you have children, is the very first place that you should be putting leftover money. And the reason that we like the RESP is because, unlike RRSPs or first-time home savings account, which give you a reduction or a tax savings, they reduce your taxable income and allow you to pay less tax. Unfortunately, on the RESP, it doesn't reduce your taxes at all. But what it is eligible is a grant. So that means you can get up to $7,200 of free money from the government simply by contributing into the RESP. And so the way the RRSP works is that from the minute your child is born, they can contribute up to a maximum per year of $2,500, and you will get $500 each year that they contribute into each year you contribute into their RESP, up to a maximum of $500. Now, the big caveat here is some people think you can go front end load this and put all the money and max it out. No, if you put in more than $5,000 in any one year, you're not going to get any more benefit than $1,000 in CESG grant money. And that's because it is typically, as we say here, $500 per year, but they will allow you to do a catch up for one previous year. So you can do a maximum of up to $5,000 if, let's say, that your kid is now 10 and you just realized that the RESP is an effective tool for you. You can go in and each year you can put in $5,000 and get $1,000 of that in grant money, for the next 7.2 years to max that out. Now, the other thing about the CESG is when you do withdraw money out of it, the money is going to be taxable. At least any growth in it will be taxable. But the good news is it's taxable to your children, who will also simultaneously have government, they'll have tax credits for their education and stuff like that. So it is a very, very effective tax strategy for saving for your children's education. Now, it only works for post-secondary education, but it is, like I said, a very, very effective tool, and the first place, if you have children, that you should be putting money each year. Now, another similar tool is the RDSP, which is the registered, so the RESP is the Registered Education Savings Plan. The RDSP is the Registered Disability Savings Plan. Again, it works very similar to the RESP, but it's for people with a registered disability. And in order to qualify for the RDSP, you must be approved for the disability tax credit, which is going to give you some additional tax savings. And the one thing that I think is really interesting is that I think that there are a lot of disabilities that people don't realize are covered by the disability tax credit. Things like ADD, things like Crohn's disease and irritable bowel syndrome. So there's a lot more things that are eligible for the disability tax credit, and accordingly, the Canada Disability Savings grants through the RDSP. So here the grant is between $1,000 to $3,500 with a maximum of $70,000 in total grant money that you can receive over the life of the beneficiary. And you can contribute here all the way up until the beneficiary turns 59. So and again, I'm not a doctor, and for the disability tax credit, you have to go through a doctor to get approved for this. But it is something worthwhile and looking at. And if you do qualify, again, in my opinion, children first, and then once the children are covered, into your RDSP. If you've still got money over that, after that, it's going to be between the RRSP and the first-time home savings account. Now, if you don't already own a home, if you've never bought a home, then the first-time home savings account is the very first place that you should save after the RDSP and the RESP. Now, this isn't going to be eligible for grant money like the other two. What this is going to do is give you the best of both the tax-free savings account and the RRSP, which we'll cover in a minute, which allows you to contribute money up to $40,000 at a maximum of $8,000 per year, starting back in 2023. But you have to have opened an account in 23 in order to get the 8,000 contribution amount for 23. If you didn't, open it right now, and you'll get 8,000 for 2024, and then 8,000 for each year to follow, up to a maximum of $40,000. Now, each contribution will reduce your taxable income by whatever contribution you make, which is the same thing with an RRSP. The difference is that with an RRSP, when you take the money out, it is taxable to you, with the exception of the first-time home buyers plan. And there are benefits to using both, by the way. But I'm going to leave the first-time home buyers account for another day. What that allows you to do is if you have money inside your RRSP, you can take a certain amount out tax-free, and then you have to repay it over a 15-year repayment cycle. So with the FHSA, you're allowed to take it out. And unlike the RRSPs, and it's not going to be taxable to you when you take it out. And so this is a really, really big advantage. It's brand new. Again, if you are not already a homeowner, this first-time home savings account is the first place that you should save. If you are already a homeowner, unfortunately, that's not really going to be much benefit to you. So the next place you might look is to determine whether you should put money into your RRSPs or into your tax-free savings account. The RRSP, so obviously the first time, let's step back for a second, take a breather and take a sip of water, because I go a little bit fast here sometimes, even for myself. So if we look at the RESP, that's a specific savings program for your children's education. You look at the RDSP, that's specific saving for yourself. You look at the RRSP, that's again specific savings for yourself for retirement. Okay, now with this, you can take money out of your RRSPs anytime that you like, but you're going to be taxed on it. There's also going to be a withholding tax, and you're going to be taxed at whatever your marginal tax rate is. Now, when you take the money out of an RRSP, you never get that room back. It's gone for good. So if you had $50,000 of RRSP, and you'd max out your contributions, and you take that $50,000 out, the next year you don't have $50,000 of room again. You will only get the room that's based off of your income. And the way it works is you've got up to 18%, up to the maximum of $31,560 for each year you earn income. So the government's going to look at your personal tax return, and they're going to assess that, and based on that, they're going to give you an amount that you can contribute to your RRSP or the RRSP room that you have. Be very, very, very careful not to over-contribute. There are penalties for over-contribution, and if you do, you want to withdraw your money as soon as possible, but speak to your accountant, because there's a specific process on what you need to do if you've ever made an over-contribution. Now, if you're ever looking to figure out how much room you have available in any of these programs, you can find them in your MyCRA account. Now, the RRSP, like I said, I love it because it does reduce your amount of taxable income. So you can think, if you're a corporation owner, and you take money out of your corporation, and give it to yourself. Now, that's a director's advance. It's likely going to become salary to you. So you've increased the amount of taxes that you're going to pay. But if you contribute that into your RRSP, that's going to lower it, offsetting it, so that you don't pay any personal or corporate tax on any money that you paid into your RRSPs in the current period. However, as we said, it will be taxable to you whenever you choose to withdraw it. And there are also some rules around RIFs, a certain amount of money that you must take out of your RRSP when you reach a certain age. And with the RRSP, for any of you who are getting closer to that RIF age, you want to look at balancing how much money you're taking out of your RRSPs, because you might want to take more out of your RRSPs than you're required to, or earlier than you're required to, so that you're not bumped into a tax bracket in retirement that results in clawbacks on OAS and CPP. And if you're wondering what those clawbacks amounts are, they change every year, but you can Google them. They're around 75,000-ish mark. So that's the first time home savings account and the RRSP. But what about the TFSA? So the TFSA is kind of the polar opposite of the RRSP. So the TFSA gives you the ability to grow tax-free. Unfortunately, the money you're contributing into the tax-free savings account is money that will have had to pay tax on it. So if you take money out of your corporation to contribute to your TFSA, it's going to become income to you. Most likely, you're going to pay tax on that, and then you'll be able to make your TFSA contribution. Now, the beautiful thing about the tax-free savings account is that any growth that you have in it is completely tax-free. Plus, if you do need to take money out of your tax-free savings account, if you wait a full year, a full calendar year, then you'll actually get that room back. So imagine that you maxed out your TFSA contribution and it was $50,000 and you took all that out for some emergency repair work to do to your house or whatever the case might be. In the next year, you could actually begin putting that money back in and you'll get that full $50,000 of TFSA room back, plus whatever room you're eligible for based on the current year. So the dollar limit right now is about $7,000 per year. We used to have the maximum, like what it's totaled up to now. Unfortunately, I don't have that. I will make sure to get that in the follow-up section because we used to have it in the slide deck. Go check some of our past webinars or Google it. And if you've never contributed to the TFSA, you'll see what the maximum amount is up to date. And you have to have been over 18 from the year it started to get the maximum TFSA contribution amount. So the next thing is, well, do I save it inside of my corporation? And the corporation is a great tool, second only to the RRSP and the RRSP and the first-time home savings account in its ability to defer taxes. So with the RRSP and the first-time home savings account, you get to, with the FSHA, you're basically avoiding tax altogether. With the RRSP, you're deferring the tax all the way until you start taking the money out in retirement. With the corporation, you're deferring a portion of that tax until you take the money out of your corporation, because you are still going to have to pay your corporate taxes at about 12.2%. And that means that you're going to be looking at only having about 88 cents on the dollar to invest. But you will have the ability to invest in just about everything that you can invest inside of an RRSP and then some, because you can do puts and calls and other things like leverage that you can't do with an RRSP. So the corporation is going to give you that ability to not have to take it into income first. So if you've exceeded the maximum benefits or maximum RRSP contribution, saving inside your corporation is an excellent vehicle and way to do that. In addition, the other benefit that you're getting inside your corporation is how your investments are going to be taxed. So if you look at an RRSP, yes, it gives you the ability to defer the full amount, not just 88 cents on the dollar. But any money that you put into your RRSP, as we said, it's taxed based on how much you pull out. So whether you're receiving a dividend or a capital gain or interest, or it really doesn't matter. It's just all income, and whatever you take out is taxable at your personal tax rate. Whereas in a corporation or in an unregistered investment account, different types of investments are taxed differently. So for a dividend, yes, you're going to pay a higher rate inside the corporation, but it's going to build up what we call a refundable tax. So RDTOH, which is refundable dividend tax on hand, which means that if you issue a dividend down to your shareholder, down to yourself eventually, which is usually the goal, the corporation will get back the taxes on the dividends. Now, in addition, if you have capital gains, the capital gains are taxed at only 50%. Many of you may have heard this before. So if you invest $100,000 and it grows to $150,000 in your RSP, you're effectively going to pay tax on that $50,000. Whereas in the corporation, you're going to pay at the corporate investment income tax rate of about 38%. but you're only going to pay that on half of it, which can give you some significant advantages of investing inside the corporation. In addition, if you have a holding company, there are ways to potentially move the tax on that investment income from 38% down to that 12.2%. So again, if you're interested in looking at investment income and your corporation and how you can minimize the amount of taxes you pay on that, again, speak with your team about a holding company or IPPs or any of the amazing tax strategies that we have available to you. The last option is going to be unregistered. So unregistered basically means it's in a personal savings account. And if you're taking money out of your corporation, it's going to be taxable to you in some way, shape, or form. And then you can invest it in these unregistered investment accounts. The only time I would recommend doing something like an unregistered investment account is if you have money from outside your corporation already to be able to invest, or you're using it for something like the Smith maneuver. So the Smith maneuver, some of you might have heard of this. It's a specific way of borrowing money and then investing it and being able to deduct the cost of the borrowing against the investment income. So Smith maneuvers are a tool that are available if you are trying to use leverage to grow your retirement. But generally speaking, I'm not a big fan of encouraging people in this market to borrow to invest. I mean, when interest rates were lower, it was a completely different story. But now it's harder and harder to be able to make sure that you've got enough margin of safety in your returns on your investment to cover your cost of borrowing, which would fundamentally be the most important step if you're ever considering using leverage. So that covers all the different vehicles that are available to you. Again, if you want to get more information or speak about your individual situation, you can reach out and speak to your account manager. For clients, please use Lisio as your primary way of communicating with your accounting team. If you're not a client and interested in learning more, you can use your camera to scan the QR code or go to our website, cpa4it.ca, and book on a free consultation to learn more about it. But at this point, I want to open it up for Q&A and see if people have any specific questions about the different vehicles or about overall strategy for building up for your retirement and savings plan. So I guess the good news is don't seem to have any questions coming in through the Q&A. Hopefully that means I've covered everything as opposed to I just didn't give you anything of value. As I said, there are a number of different tools available to you. We got our first question. Rob's good for now. Awesome. And the key is figuring out for your personal situation what makes the most sense. So do you have kids? Are you looking to buy a house? So Gord's got a question. He looks like he just needs a second to type it out. So I'll hang around for you, Gord. Just type that question out and I'll be happy to answer it for you. But you're looking at your personal situation. Like, so do you have children? Are you looking to buy a home? And that's going to help us determine where you should be putting your hard-earned money. We're usually big fans of investing inside the corporation, but a lot of that, again, is going to come down to your overall strategy as far as like, are you planning to keep your corporation around forever, or is this a temporary thing and you're going to go take a full-time role? So we've got our first two questions. I'm going to answer Gord's first. So is there a maximum threshold when it comes to retaining funds in the corporation? Yes, there is, but it's pretty high. It is the small business deduction limit of $500,000, because if you exceed $500,000, then you're no longer eligible for that amazing small business tax rate here in Ontario of only 12.2%. So what we would highly recommend is that if you're above that, then we look at some other strategies like IPPs or things that we might use to lower your taxable income. And an IPP is a really interesting thing because it's not actually technically inside your corporation. It's a little bit more like an RRSP, but it's different from an RRSP, and very, very effective for anyone who's bumping up against that $500,000 threshold. Yes, I'm talking in 1 year. And I guess as far as total money that you have inside your corporation, no, not necessarily a problem as far as a limit or anything. Again, how much income is that generating? And how is it going to be taxed is an important factor. And it looks like uh, we have another question coming through from Facebook, which I'll get to in just a second, but I've got another one from the attendee in the Zoom. Is it true that registered savings plans cannot include trading options? Again, speak with your broker or whoever you're using. But my understanding is that you can't do puts and calls and RRSPs. You get, for certain, you cannot use leverage in an RRSP for sure. You might be able to do puts and calls. Again, I'm not an investment advisor, but an investment advisor could get you more information on that. And so it looks like we got a couple of questions coming through from Facebook. So do you have any guidelines on when it's advantageous to pull money out of your corporation to pay off your personal mortgage now that mortgage interest rates are so high? So yes, they're high compared to what they've been, but things are all relative. If you were to ask my dad if mortgage interest rates are high, and given that he lived through the late 70s and the early 80s and had, and went bankrupt during that period when interest rates went to double digits and rent controls were put in, he'd probably say they're not that bad. So when it comes to figuring out whether you should take money out of your corporation to pay off your mortgage, you want to look at your personal tax bracket. So how much money are you going to pay in tax versus how much interest would you reduce and then amortize that over the life of the loan and do a heads up comparison to look at whether there's, it's beneficial to pay off your mortgage, because a lot depends on your tax bracket. If you're, over $250,000 and everything's going to be taxed at the higher tax bracket, at 53%, you can carry a lot of interest for a long period of time. And especially if you also factor in the fact that if you didn't pay it off, if you didn't take the money and pay off your mortgage, it would in theory be in your corporation invested, generating a return, right? So the other question too is, what kind of income are you earning with the money that you would use to pay off this investment? If it's generating no income whatsoever, obviously there's going to be a larger benefit to paying off the mortgage. But if it's invested and if it's, if it's generating in returns about what your cost of borrowing is, odds are it's better to leave it inside your corporation and carry the interest, because not only would you lose the opportunity cost of investing that money and generating income in your corporation, but you'd also have a big tax bill to pay to get it out of your corporation. So I hope that helps. And from Jason on Facebook, if you have children that are older than 18 and they haven't gone to post-secondary school, would you still be able to contribute to an RRSP? I don't believe so, but I'm going to double check, because I think that you'd be past the limit. But what I'm going to do is I'm going to check with our chatbot on our website, cpa4it.ca. Because normally I'd have to do a bit of research on this to confirm that. But give me 1 second and I'll be able to post that in our chatbot and see what it says. Thinking. Okay. Children are older than 18 and not yet pursued post-secondary education, you would not be able to contribute to an RRSP for them. RRSP contributions can only be made until the end of the year in which the beneficiary turns 17. After that, no further contributions. That was my understanding. Glad I was able to confirm it for you. So I guess the short answer is no. Sorry. And Rachel already answered that for me. Um, And Rachel just followed up with the child. Once the child turns 18, they could also become the subscriber of their own RESP and request the CLB benefits for themselves until the day before they turn 21. Okay. Excellent. Okay, thank you, Rachel. Rachel is just following up with the answer, and it looks like so. Another question from Gord says, "You said that the investment income in the corp is taxed at 38%, so that compares to one personal marginal tax rate. Any comment?" So it's a little bit more complicated than the 38%. I said 38% to keep it simple. There's federal tax abatement, some other things that go into play. There's also, like I said, the ability to use a holding company to effectively move that from the 38% down to the corporate tax rate. In addition, with the dividend, again, you're paying 38%, or sorry, on the capital gain, you're paying 38% on only half of it. And then with the dividend, while you're paying the 38%, it's a refundable tax. So you get it all back if and when you issue a dividend. So again, corporation is in some ways better than certain vehicles. But again, you will still have to pay, your corporate tax on the income that you're going to invest. So you're down to about 88 cents on the dollar to invest. And then the income is taxable. Again, with the RRSP, for example, the income will eventually be taxable, but it's not taxable until you take the money out. Whereas in a corporation, it's taxable when you receive it. So if you actually sell something and get a capital gain, it's going to be taxable then. If you're receiving a dividend, it's going to be taxable then. If you're receiving interest, it's going to be taxable then. So I hope that helps. I think that's the last of the questions. I'll give it one more second here, just in case there are some more questions that come up. Otherwise, thank you everyone for joining us today. Again, we've got another amazing episode of Friday AI coming up this Friday, talking about onboarding. We've also got another webinar scheduled in a couple weeks. So when in doubt, go check out our events page on our website, cpa4it.ca, to see what's coming up in the coming months. Next one's going to be on how to avoid common pitfalls when incorporating. And the one after that is how to master QuickBooks Online for effortless bookkeeping. So come check these out. We love connecting with you guys and look forward to talking more. And with no further questions, I will thank you again for your time and see you in a couple weeks. Bye for now.